Welcome back to another video, everybody. So in this one, we're going to be breaking down some new data, some new statements, and honestly new guidance that the market has recently received that is going to tell us pretty much exactly what's going to happen going into the end of the year. There are some warning signs that you as an investor and honestly as kind of a participant in the economy need to know about right now in order to best position yourselves going forward. Now, we're going to be talking about the gamma potential that we saw with the market that we were talking about in yesterday's video. We have an update on that. We have some new data there. We have some statements from the Fed members. We have some energy crisis news going on in the UK right now. And there is something that nobody is talking about right now. They are focused on something else where they really should be focused on a date that is actually closer in time. Again, guys, we have a lot of information to cover here. Very, very relevant information going into the next couple of weeks and quarters. So let's get right into it here. Make sure you guys hit that like button on the video down below. And make sure you guys hit that subscribe button for more videos like this. You will not find this anywhere else. So let's get right into it here. So first, we need to break down the technicals of the SPY. Now, if you guys have been kind of hanging around this channel over the last couple of weeks and months, we saw this run up here to around 430. We essentially called this 2AT. We were screaming from the rooftops that we were not going to be able to sustain this move up to the upside here. That was due to a lot of shorts getting squeezed out of their positions coming up here. And then we had a lot of that basically options expiring going into that August date. Now, again, we are hunting this daily 1348 cross down right here. And as we can see here, this is one of the reasons why this has been a studied indicator. It is the most profitable crossover that exists. Now, again, I kind of want to shout out a little bit of what we've been working on over here in our group as well. Again, this trading algorithm, Trader Joe, in this time period is following all of the rules. It is now up about 24% since inception. It is absolutely sparking every single hedge fund right now. So if you guys are interested in getting access to these proprietary algorithms that show you exactly what they are doing, make sure you check out that link down below. Again, you are not going to find that type of stuff anywhere else. Now, again, let's kind of get into a little bit where we could see the SPY going over the next couple of days and weeks. Well, we do have this level down here right around 392, 393, and I could easily see the market heading back down to that level here. Below that, we're going to have 381, and if we bring this on the 4-hour time frame as well, we're going to get a couple of other different levels as well. We have this 390 right here that a lot of people are looking for a bounce off of, which is very possible. And then below that, again, we are going to be having that 370, that 385, 380 levels as well. Now, let's kind of get into a couple of these kind of blaring indicators right now that everybody needs to be aware of, and it's statements from the Cleveland Fed President Loretta Mester. She made it very clear that the Fed's hands are somewhat tied due to inflation and unemployment data, and even if the latter worsens. Then we're going to get into that a little bit later about who the real losers of this situation is here, because the Fed is in a situation where they are not able to win without making some sacrifices. And we're going to go over that and make sure that you guys are prepared. So my current view is that it will be necessary to move the Fed funds rate up to somewhat above 4% by early next year and hold it there. Now, she also does not anticipate the Fed cutting the Fed funds rate target next year. Now, the interesting thing about that statement there is that there was a lot of kind of back and forth on whether or not the Fed was looking to cut interest rates at the end of 2023. After Jackson Hole and kind of the whole situation that followed after, the Fed is sticking to their guns right here. And even if we see growth slow down, higher unemployment, they are going to stick to their guns and trying to get inflation down. But we're coming into a time period that is going to make it so incredibly difficult for them to do so. And we're going to go over that in a second as well. But this is the date that I want everybody to really focus in on over here. So, the European Central Bank meeting is going to be on September 8th, the ECB meeting here. So no, there's a lot of banking institutions that are coming out now and are fully expecting the ECB to raise interest rates by 75 basis points. We now expect the ECB to hike 75 basis points next week, which will be followed by 50 basis points in October, 25 basis points in December, which again, nobody really has a good understanding of right now. They have to see how the data, the inflation data, unemployment data, all those other key economic data points kind of result after some more of these rate hikes. Now, but they acknowledge the increased uncertainty on the latter two hike size expectations. Now, We believe the euro area will face a recession and the ECB will hike into that, very similar to what's going on in the United States right now. However, we also acknowledge that even without the ECB tightening, the European economy is in a severe situation to begin with, a worsening energy crisis. Now, we're going to get into this energy crisis situation in a second, but you have to think about the ECB very similar to the US Fed. If we start to see a lot of volatility coming over from the European markets based on this meeting next week, that is going to spill over into the US markets as well and give us some more volatile price action. Now, again, if you do know how to take advantage of that, that is going to be awesome. But again, for those of you guys that don't, it's going to kind of bring a lot of pain into the overall market heading into September, typically one of the worst months of the year. Now, getting into this energy crisis situation right now, we have a couple of statements about what the EU is actually going to be planning on doing. Now, currently, gas dominates the price of the electricity market. With these exorbitant prices, we'll have to decouple. We'll have to ensure renewable energies are generated at lower costs, that those costs are transferred to consumers, and windfall profits used to help vulnerable households. It may be that we have a number of winters where we have to somehow find solutions through efficiency savings, through rationing, and a very, very quick build out of alternatives. Now, here's kind of the deal of what's been going on. So the oil market right now is facing a very interesting supply and demand situation. Due to the Russia conflict over with Russia and Ukraine, there is going to be less supply of oil worldwide. Now, right now, as we are speaking, there isn't really all that much of an issue with demand across the board, or it at least hasn't gotten up to a very, very critical level. Yes, we have seen oil prices start to increase, and that has been a very key component of the increases in the CPI and the inflation reports that we've been seeing. But as we get into winter time, the demand for oil, natural gas to heat your home and everything like that is going to significantly increase. So the Fed and all of the other large central banks around the world have a very, very interesting issue here. They're trying to get inflation under control. They have increasing unemployment, decreased growth. We saw just today Snapchat is going to be laying off 20% of its workforce. So we have to think here, well, what is the Fed actually going to do, and how is this going to affect everyday consumers? The people that are going to be hurt the most are going to be the middle class, and lower class individuals, because here is why. Right now, with the Fed increasing interest rates, if you want to own a home, the value of your home is going to decrease. Now, again, it's going to cost you more to heat your home when we get into these winter months, so that is going to be another cost that you're going to have to endure as well. With food prices still continuing to rise, that is going to drain on you as well, but the Fed is going to continue to increase these interest rates in order to get inflation under control. But they don't really have much control over what goes on in the oil market or the housing market or any of these other markets that are going to play a very key and pivotal role in where inflation is going to go. That's why you are starting to see now a lot of these members of the Fed come out and say, well, we have to basically scorched earth and almost get into Volcker-like policies where they're going to be trying to increase these interest rates, try to get inflation under control before we get into these winter months, and try to stabilize everything going into 2023. But that doesn't mean that the markets are going to hold up. When you look at the technicals of the SPY, going back to what we were just looking at over here, overall, the market has gone on this little run here with that increased short covering, and you are starting to see things come back to the downside. And in addition to this, we didn't talk about this before, but we need to talk about this right now, is if you look at this chart right here, actually, let me pull this up for you guys. You guys can't see that. If you look at this chart right here, you can see that the billions of open buy premium is going to be on this y-axis here. Stock puts is on this red line here, and you are seeing it start to skyrocket. Remember yesterday when we were talking about gamma going into the negative, and if that the markets continue to slip, you're going to see that delta hedging to the downside with those deep out of the money puts increasing their deltas, which is going to make those dealers or option sellers go out into the open market and short more in order to hedge those contracts that they are selling. Well, this is what we're looking at here. The last time that we saw this peak was right around November, December. Well, what was the market doing in that time period? If you look at SPY on the daily time frame, where was that? Well, you can see that going into November and December, we were at those peaks, those all-time highs, 480 on the SPY. So seeing the derivatives market and everything else that is going on right now, the pain is not done in the overall market, and you guys need to be able to protect yourselves in your trading accounts, in your long-term portfolios, and make sure that you are set up going into the next couple of weeks and months. So guys, that is going to wrap up this video for you guys this evening. If you did enjoy the information and analysis that I provided for you guys in this video here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a good evening. I'll see you in the next one. Peace.